in order to keep the system going, they can't let money supply decline. But they've let money supply decline, which tells me the plan is to tank the entire credit system. And that's how you will own nothing. The you'll be happy part, I don't know what they're going to put in the water or the air, but that's how you'll own nothing when credit collapses.
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it. In a world teetering on the brink of immense change, where the shadows of uncertainty loom large over every nation, a seismic shift is underway. The very foundations of our global economy, the trust we place in paper currencies, are being shaken to their core. It's not just speculation, it's a transformation that could redefine wealth, power, and stability as we know it. As geopolitical cauldrons simmer and economies waver like a ship amidst a tempest, there's a silent yet profound movement afoot. The big money, the unseen hands that shape our world, are quietly but decisively turning their backs on the once almighty dollar, pivoting towards an asset that has stood the test of time: gold. And not just any shift, but one so bold, it's set to catapult gold to a staggering $8,888 per ounce. You might think this is the stuff of financial fantasies, but the tremors are real and the implications immense. We stand at the precipice of witnessing gold not just as a safe haven, but as the burgeoning sovereign of global currencies. Why is this monumental shift happening? What drives the titans of finance and the guardians of national treasuries to hedge their bets on gold? How could this reshape the global power dynamics and your very own financial future? All these questions and more we're about to unravel, step by intricate step, in today's deep dive. But before we get into it, I'd just like to say thank you for subscribing and showing support. Researching and editing takes me a lot of time to do by myself, so I always appreciate the support and amazing feedback. In this comprehensive expose, we'll navigate through the labyrinth of current geopolitical tensions, dissect the formidable forces driving the gold market, and decode the signals sent by central banks across the globe. From the power corridors of BRICS nations charting a new course in global finance to the subtle yet strategic maneuvers of China's central bank, every move is a piece of the puzzle. As this narrative unfolds, the implications for you, the investor, the observer, the citizen of this interconnected world, become increasingly profound. Our journey begins with insights from the esteemed Peter Grandich, a voice of reason in the cacophony of market speculations. His astute observations and predictions have been a beacon for many in navigating the stormy seas of the financial markets. As we transition to his segment, brace yourself for revelations that might just redefine your understanding of wealth and power in the days to come. Stay tuned, as this narrative is not just about observing. It's about preparing, adapting, and being part of the change that's set to sweep the globe.
Last year, 11 of the 12 months were reduced lower, and the 12th month was just left alone, for almost 500,000 less people than employed. And if you think about it, of those 11 months, 6 would have actually been down, and a few others would have been far less than reported. And therefore, when they first came out as they were, the Biden administration, the economy is strong, Bidenomics is working. And then by the time they get readjusted, they're into the new fake number. And it's really shameful. I'm not the first to say this, but I said it for all of 2023. The BLS should just get rid of the L and just call themselves BS, because that's what it's really been. And remember, the Federal Reserve is supposed to be basing their decisions on these labor numbers, supposedly. And if that's the case, I don't know anybody, if I had anybody who was advising me and was wrong 11 out of 12 times, I don't know if they'd be working for me next year, Elijah. So it's very disconcerting. It gave a false opinion. It created all this Wall Street Goldilocks stuff, and and that's what came together. The sort of market rallied saying everything was going to be hunky-dory again. And now as we start off the new year, people realizing that's just not the case, at least some are.
Navigating the turbulent seas of global finance, Peter Grandich's insights serve as a lighthouse, revealing the concealed reefs beneath the seemingly calm surface. His analysis doesn't just hint at discrepancies. It exposes a chasm between the projected image of a thriving economy and the stark reality that the numbers narrate. All last year, 11 of the 12 months were reduced lower. Grandich states not just challenging the official narrative, but dismantling it piece by piece, revealing a landscape fraught with misrepresentation and disillusionment. In a world where economies hinge on the perceived strength of their labor markets, Grandich's revelations are akin to pulling back the curtain, only to find the gears of the economic machine not just rusted, but fundamentally broken. The labor numbers, traditionally seen as the pulse of economic health, are not just offbeat, but seemingly orchestrated to a different tune. One that sings of stability where there is turbulence, of prosperity where there's uncertainty. This stark divergence from reality to reportage isn't just a matter of statistical adjustment. It's a profound reflection of the chasm between the narratives we're sold and the economic ground realities. But why does this matter in the grand discourse of gold's resurgence as a global standard? The answer lies not just in the disillusionment with the official numbers, but in the cascading effect of this disillusionment on policy, perception, and ultimately, on the sanctuaries we seek in times of economic turmoil. If the labor statistics, a cornerstone for policy decisions by central institutions like the Federal Reserve, are shrouded in doubt, what does that say about the decisions based on these numbers? It's a domino effect where misplaced optimism, fueled by Goldilocks narratives, leads to policy missteps, market volatility, and profound erosion of trust in traditional financial bastions. Greenwich's critique isn't just a commentary, it's a clarion call to acknowledge the cracks in the financial edifice we've constructed. As these cracks widen, the allure of gold, with its timeless sheen of stability and value, becomes ever more compelling. In a world teetering on the fulcrum of financial uncertainty, gold's historic role as a safe haven is not just being revisited, it's being reinstated. The shift towards gold is not a knee-jerk reaction to transient economic tremors. It's a calculated strategic move by those who sense the undercurrents of change, by those who understand that when faith in traditional financial structures wanes, the true worth of gold is not just preserved, but accentuated. As we parse through Greenwich's insights, we're not just understanding the discrepancies in labor numbers, we're uncovering the layers of economic narratives that have been meticulously crafted and the inevitable awakening to the reality that these narratives conceal. This awakening is not just a realization, but a transformation, a shift in perception that's steadily redefining the contours of power, wealth, and stability in the global economy. And as this transformation unfolds, the discourse transcends to a broader canvas where individual narratives interweave to form a larger picture. This is where Bill Holter's profound insights come into play, shedding light on the global race to dump the dollar. Holter, with his keen understanding of the intricate tapestry of global finance, will take us deeper into the dynamics of this race, unraveling the motivations, the strategies, and the implications of this monumental shift. As we pivot to his segment, brace yourselves for a journey into the heart of global finance, where the race to dump the dollar is not just redefining the rules of the game, but is also setting the stage for a new era in the global economic order. Stay tuned as we explore this pivotal chapter in the saga of gold's resurgence and the evolving landscape of global finance with Bill Holter.
That's pretty obvious that's happening. Just understand that the BRICS, Russia, China, and obviously China's having their own problems because they blew up a huge credit bubble. But they fully understand that the reason, for example, the reason gold has been trashed for years and years is to prove and point at dollar good, gold bad. And the reason that they do that is so that the U.S. Treasury continues to have the ability to borrow whatever they need to borrow to cover the deficits. And the BRICS nations know this. And I would just say, and I'm not sure if Sun Tzu actually said this or not, but the best way to win a war is without firing a shot. And I think if you go back to, what was it, Chairman Mao back in 1971, saying we now see the end of the dollar in sight when the U.S. went off the gold standard. So I think the BRICS fully understand what's going on. You know, that it's been a charade, it's been a Potemkin village, and they're basically allowing the U.S. to spend itself into the ground and bankrupt itself and literally let Mother Nature blow it over rather than having to go, head to head. And I also believe, I've said this on several interviews now, I think it's really important to go back and read Vladimir Putin's, I think he's done 6 or 7 speeches since the original invasion. Read those speeches and see if you disagree with anything that the man says, because really all he wants is free and fair settlement and does not want a NATO country on his border. And Russia was promised in 1998 that NATO would not move 1 inch toward the Russian border. And all you have to do is look at an interactive map, and you can see basically their border has been surrounded, and the U.S., NATO, flat out lied back in 1998 because the Russian border is or has been infringed upon. So I think it's important to read his speeches and understand that they absolutely know where the U.S. is. And this is, if you want to call it a reversal from the 1970s, the Soviet Union bankrupted themselves with Afghanistan. And I mean, here, the U.S. is like the Roman Empire. We're so spread out, and we've spent. I just read an article the other day. We're actually running low on ammunition, and we've spent very expensive munitions to stop, $2,000 drones.
In the intricate web of global finance and geopolitical strategy, Bill Holter's insights emerge as a beacon, illuminating the shadows cast by the complex interplay of international powers. His discourse takes us beyond the surface, revealing the underlying motives and maneuvers that shape the economic fate of nations. Holter succinctly deciphers the chessboard of global politics and finance, where gold and the dollar are not just currencies, but symbols of power, sovereignty, and strategic dominance. Holter's analysis unveils a narrative that's both compelling and unsettling. The BRICS nations, led by the astute strategists of Russia and China, are not merely players in the global financial arena. They are architects of a new order, one that seeks to dismantle the dollar's hegemony and reforge the chains of economic power. The devaluation of gold, as Holter indicates, is not an arbitrary market fluctuation. It's a calculated move in a game of economic chess designed to uphold the dollar's dominance by juxtaposing its stability against the volatility of gold. This narrative, however, is not just about gold or the dollar. It's about the fundamental shift in the axis of global financial power. The strategy of the BRICS, as articulated by Holter, resonates with the ancient wisdom of Sun Tzu: to conquer without conflict, to win the war without firing a shot. This strategy, rooted in patience and foresight, sees the dollar not as an adversary to be overthrown, but as an empire that will crumble under the weight of its own excesses. Holter's reference to Chairman Mao's foresight during the Nixon era, when the dollar was unpegged from gold, highlights a historical pivot point that set the stage for today's unfolding drama. Holter's discourse also sheds light on the geopolitical chess game, where territories are not just land, but markers of influence, control, and potential conflict. The encroachment of NATO towards the Russian border, a promise unkept since 1998, is not just a breach of trust. It's a maneuver that's reshaping alliances, strategies, and the very fabric of international relations. The narrative here transcends economics. It's about survival, sovereignty, and the strategic repositioning of nations in a rapidly evolving world order. In this grand design, the United States, as portrayed by Holter, is an empire, overextended, reminiscent of the Roman Empire in its twilight. The depletion of ammunition, a metaphor for the waning influence and resources juxtaposed against the strategic acumen of adversaries, paints a vivid picture of a superpower at a crossroads. This is not just about military might or economic prowess. It's about the strategic recalibration of a nation that once dictated the terms of global engagement. As we digest the profound insights shared by Bill Holter, we stand at the precipice of a new chapter in global finance and geopolitics. The shift from the dollar to gold, the repositioning of global powers, and the strategic maneuvers that underpin these shifts are reshaping the world as we know it. But the narrative is far from over. Up next, we have the seasoned perspective of David Morgan, a renowned precious metals aficionado and a keen observer of the global economic landscape. Morgan's insights into the silver market, his analysis of precious metals as economic indicators, and his foresight into market trends promise to add another layer of depth to our understanding of this complex, evolving saga. Stay tuned as we delve deeper into the insights of David Morgan, unraveling the nuances of the precious metals market and their pivotal role in the tapestry of global finance.
I mean, the reason that I've devoted my life to this is because it's mathematically impossible for a fiat debt-based monetary system not to fail. And of course, a lot of people go to the extreme and say, well, that means the dollar's worth zero. I don't think we're ever going to get a zero worth dollar, but its trend is definitely there. The 1913 dollar's worth about 2 cents. But No, the end game, I don't know. What I do know is what they want. And we talk about this almost every show, and that is they want to implement a new system. And then how do you get to the new system? Well, the first thing is the narrative. What story do you tell everybody so it's not the bank's fault and everybody wants to keep their confidence in the banking system? So you have to come up with a good story, which could be like a cyber attack, for example. And then you tag it with whatever, enemy de jure there is. The Ministry of Truth comes out and says, oh, it's the Russians. Well, wait a minute, we used the Russians too many times. It was the Chinese, or there was a rogue state in, the Middle East, whatever. Who knows what they'll come up with. Could be a false flag, meaning that it is a true cyber attack, but it isn't actually done by anybody that's named and pointed out and made the victim. It could be someone, I say it, but someone within the confines of the banking structure, or let's say the system as it exists, deliberately doing and acting as if they're a bad actor, which gives a great excuse. Geez, we're really sorry. We thought we had our security detail really, really on the up and up, but found out that this really smart hacker was able to do this to us. It'll only be a few days, we'll be up and running. But oh, by the way, you need to 1, 2, 3, get a digital ID, do an iris scan, do a thumbprint, whatever. And that's all conjecture on my part, but I think it's a fairly likely scenario. Will it be exactly that? No, it'll be different than what I outlined, but it could be along those lines. So, so to answer the question again, because it's really important, no, there's no way out of this mess. Something's got to give. And we just don't know what that looks like. Do all the debts that exist go away because they can't find them on the computer anymore? Do just certain debts go away, like government debt goes away, but your household debt for your mortgage and your car loan stay in place? Your school loan still stays in place? It's a very precarious situation. In a debt jubilee, all debts are forgiven. So that means, who owes the national debt? Well, the U.S. citizens owe it. And who do they owe it to? A private banking corporation called the Federal Reserve. And yes, the Fed gives money to the Treasury, and there's all this kind of convoluted stuff that's happened in the last many years. But nonetheless, brass tacks simplified, the U.S. citizens, well, they owe it to themselves. No, you don't owe it to yourself. You owe it to a private corporation. And that corporation is in charge of running your government because they print the money. Well, the Treasury prints it, but the Fed borrows it at cost. So, a $1 bill costs them 5 cents and a $100 bill costs them 5 cents. And then they loan it at face value plus interest. It's pretty neat counterfeiting scheme if you can do it. And of course, it's a monopoly and it's legalized. So it's a mess. And will the new system be any better? And the answer is probably worse what they're planning, because they're planning to just do away with the printing press, basically go to a cashless society and implement it on a digital basis only, and basically either have it on your phone or your phone. It could be on your laptop. People that don't have a phone, I don't know what they do. I certainly, they give you one, I don't know. But it's going a very scary direction in my view, but it's not there yet. And there are, of course, there's pushback. There's the crypto sphere, which is pushing back somewhat, although Bitcoin's pretty much become institutionalized. In my Crypto Conspiracy Theory of 30 podcasts, anyone's really interested can learn by, I think it's number 14 in that series, that, basically MasterCard's taken over Bitcoin for a large extent. And of course, now you've got Larry Fink in there with the new Bitcoin ETF. Anything in the monetary realm, these bankers aren't going to want to lose their monopoly. There's no doubt about that. They just have to have a good story to keep us in their system.
In the labyrinth of global finance, David Morgan's perspective serves as a piercing ray of clarity, unraveling the complexities of our debt-based monetary system. His profound understanding resonates with a hard truth, the inevitability of the failure of a fiat currency system. Morgan doesn't just outline the decline, he delves into the intricacies of how this decline is being managed, orchestrated, and narrated by the powers that be. His discourse isn't just about the inevitable devaluation of the dollar. It's a deep dive into the strategic maneuverings that underpin this devaluation and the grand narrative that's being woven around it. Morgan's insights are not merely observational, they are prophetic. He doesn't just foresee a decline, he paints a vivid picture of the mechanics of this decline, a narrative carefully crafted, a cyber attack strategically utilized, and a populace subtly nudged towards a new digital order. This isn't just a shift from physical currency to digital. It's a meticulously orchestrated transition to a realm where every transaction, every interaction is monitored, measured, and controlled. The narrative Morgan presents isn't just about economic transformation. It's about the metamorphosis of freedom, privacy, and autonomy in the face of an ever-encroaching digital panopticon. The scenario Morgan paints is one where chaos isn't just a byproduct. It's a tool wielded with precision to disorient, to destabilize, and to steer the masses towards a preordained destination. The end game, as Morgan articulates, isn't just about transitioning to a new monetary system. It's about the consolidation of power, control, and surveillance in the hands of a few. The Debt Jubilee, a concept that traditionally symbolizes liberation, is reframed in Morgan's narrative as a sleight of hand of maneuver that liberates not the indebted but the debt holders, not the populace but the power brokers. In Morgan's narrative, the new system isn't a beacon of hope. It's a mirage of freedom, a digital dystopia cloaked in the guise of efficiency and convenience. The bankers, the architects of this new realm, aren't just adjusting to a new economic order. They are scripting it, ensuring that their grip on the monetary reins remains unchallenged, their monopoly unthreatened. The rise of cryptocurrencies, a potential counter-narrative to this monopoly, is acknowledged by Morgan, but with a caveat: the institutionalization of the cryptosphere, a co-option of dissent, a taming of the renegade spirit of digital currencies. As we absorb the gravity of David Morgan's insights, we stand at a crossroads, not just of economic policies, but of principles, values, and the very essence of what it means to be free in an increasingly digitized world. The narrative we're unraveling here isn't just about gold's resurgence or the dollar's decline. It's about the fabric of our future, the shape of our societies, and the essence of our individual and collective autonomy. But the story doesn't end here. Up next, we have the astute observations of Alasdair MacLeod, a financial expert whose acumen and foresight have shed light on the complexities of global economics and finance. MacLeod's insights into the macroeconomic trends, his analysis of monetary policies, and his deep understanding of the economic undercurrents promise to add another layer of depth to our exploration. Stay tuned as we delve into the profound perspectives of Alasdair MacLeod, unraveling the next chapter in this intricate saga of gold currency and the future of our global economy.
Captains of industry is not giving you the picture of actually what's going on. So when it comes to the banks, however, the banks do their own research. They understand this. They understand that their customers up and down the country are in increasing difficulties. And this is why they don't want to lend them any more money. This is why money supply isn't expanding anymore. You know, the banks are saying, whoa, hold on. Because a bank cannot really, the entire banking system cannot easily reduce the deposit liabilities to all its depositors and, checking account holders and whatever. What it can do, however, is it can stop the expansion by, refusing to lend any more money to people, with overdrafts and all the rest of it, and literally calling them in. They can do that. So what they do instead, and this is the thing that gets shifted without anybody really seeming to understand it, they can shift the risk away from the private sector, which is struggling, and invest in US Treasuries. US Treasuries, 6 months, 5.4%, what's not to like? And not only that, but under the Basel III rules, they find that large deposits are penalized. They can't use them as a source of funding the asset side of their balance sheet easily. It's something like a 50% haircut. Whereas small depositors are deemed by Basel III to be very, very safe, like a sort of only a 5% haircut. So what do the big banks do in America? They tell the money funds, sorry, but we're not going to take your position through the money market. We're not going to take your deposit through the money market. No, forget it. So they go to the Fed, and the Fed does a reverse repo. And that's fine. It's slightly inconvenient because the reverse repos is an overnight thing and it's got to be rolled and rolled and rolled and rolled. So you've got to have someone rolling it all the time. I suppose it's automated to a degree, but But at the same time, you've got the U.S. Treasury very happy to borrow money off you, or borrow money off, the money market funds, and give them 5.3, 5.4% for up to 6 months. So that's where it's all going. In other words, what we're seeing is the private sector is being starved of funds, while at the same time, the government is just hoovering up all the credit within the system, which it is spending non-productively and ensuring economic collapse. And this is the way in which I'm afraid the whole thing is going.
In the intricate tapestry of global finance, Alasdair MacLeod's insights serve as a critical thread, weaving through the complex interplay of banking systems, monetary policies, and the broader economic landscape. MacLeod's discerning analysis brings to light the nuanced maneuvers of the banking sector, a sector that, contrary to the tranquil facade often presented, is navigating through turbulent waters with a cautious, calculated approach. MacLeod's narrative reveals a banking system in a state of introspection and restraint. Banks, the traditional conduits of credit and growth, are trading carefully, acutely aware of the increasing difficulties faced by their customers. This isn't just a shift in lending practices, it's a strategic recalibration. The decision to halt the expansion of money supply to refrain from extending further credit isn't merely a reaction to current economic conditions. It's a deliberate defensive stance, a move to shield the banking system from the burgeoning risk of customer defaults and economic downturns. Yet, as MacLeod astutely points out, the banking system's strategy involves more than just tightening the purse strings. It involves a strategic reallocation of risk, a subtle yet significant shift from the precarious private sector to the ostensibly safer harbors of U.S. treasuries. This shift, underscored by the attractive returns on these treasuries and the nuanced implications of Basel IUI regulations, isn't just about securing better returns. It's about navigating through an economic landscape that's increasingly fraught with uncertainty, about seeking stability in a terrain that's perpetually shifting. The implications of this strategic shift are profound. As banks pivot towards government securities, the private sector, the engine of growth and innovation, finds itself in an increasingly parched landscape, starved of the funds that fuel expansion and progress. This isn't just an economic realignment, it's a paradigm shift, a reconfiguration of the flows that nourish the economic ecosystem. The government, in its quest to hoover up credit, isn't just absorbing financial resources, it's rerouting the lifeblood of the economy, channeling it away from the fertile grounds of the private sector to the sterile vaults of non-productive governmental expenditure. MacLeod's insights don't just illuminate the maneuvers within the banking sector. They shed light on a broader, more ominous trend. A trend where the symbiosis between the banking sector and the broader economy is being subtly yet fundamentally altered. A trend that, if left unchecked, could herald a spiral into economic stagnation or worse, collapse. As we ponder the gravity of Alasdair MacLeod's insights, we stand on the brink of a deeper understanding, not just of the banking sector, but of the intricate interdependencies that underpin our global economy. The narrative unfolding before us isn't just about the resurgence of gold or the decline of the dollar. It's about the very sinews that bind our economic systems, about the forces that shape our financial destiny. But the narrative doesn't end here. Up next, we have the perspective of David Hunter, a strategist known for his acute market foresight and his ability to navigate the complex terrain of financial markets. Hunter's insights into market trends, his analysis of economic cycles, and his predictions about the future of finance promise to add another layer of depth to our exploration. Stay tuned as we delve into the profound perspectives of David Hunter, unraveling the next chapter in this intricate saga of global finance and the forces that shape our economic future.
So you think you're doing okay, but you're actually getting exhausted. Look, I always said if you're going to compare Powell's war on inflation to Volcker's war on inflation, use the same scale that Volcker used to measure inflation in the 80s and the 90s that we used. We've tweaked that scale, and it's eye-popping, boring to get into all the details and stovepipes of how we've manipulated the BLS. I've always joked it's like a fat camp where you're getting fatter every day, but they tell you you're losing weight because they don't measure fat based on chocolate, beer, or pizza. So they just carve those out, or they de-weight those. So as you're getting noticeably larger, the scale is getting noticeably lower. The scale that we use in the 80s and 90s would put inflation, if we're saying it's 3%, that means it's 6 to 8%. And if we're saying it's 9%, it's closer to 18%. In other words, is a fantastic effort to tell a good narrative in DC through the Bureau of Labor Statistics to tell us what the official inflation is, but we all know it's higher than reported. There's also no doubt that because of rising rates throughout the last 15 to 16 months, there have been disinflationary forces because the middle class has been crippled by rising rates and higher inflation, costs were higher, there's an invisible tax, and then rates were going up, so the cost of borrowing was higher, so there was less demand, there was less momentum, so that was disinflationary temporarily. Now, we're going to see higher inflation when the Fed has to monetize more debt. Higher inflation is okay if you have a mortgage that's fixed, or you have a mortgage that's, as long as your wages go up with inflation. And, if the Fed reports misinflation incorrectly, then your employer is going to adjust for inflation incorrectly. So you're still losing. If your stock market portfolio averages Jeremy Siegel's 8% a year or better, but if real inflation is right around there or not higher, you're again running uphill in roller skates. You're feeling better to see a positive return on your S&P, but the inherent purchasing power of the money you measure your wealth with is getting weaker. And that's why if your central bank themselves won't become gold-backed to protect their currency, individuals can become their own central bankers by acquiring physical gold to protect your purchasing power. It's not a get-rich-quick scheme. It's not Bitcoin. It's not a SPAC. It's not a dot-com stock in the 90s. It won't make you uber wealthy. It will prevent you from getting poorer. In some cases, it will also make you wealthy. Again, my colleague Egon von Greyer's, whom we named Matterhorn, now von Greyer's after, is buying gold at $200, $300. He's not stupid. He did get appreciation, but more importantly, he protected his wealth. And all our clients in 90 countries who have a significant high net worth, yes, they want to see gold go up in price. It appreciates like any asset. But most importantly, the purchasing power of whatever currency they came to us in, whether it was a kroner, whether it was a euro, whether it was a peso, whether it was a yuan, whether it's a Swiss franc, has gotten stronger because it's backed by gold. And again, gold isn't as sexy, nor is it as volatile, and in some cases as euphoric as Bitcoin and others. I don't mock them, but it certainly protects your purchasing power better. For people of wealth, they've learned, and I've learned on Wall Street, when I won the lottery ticket on a dot-com stock, it's okay to be wealthy, but the secret to wealth is not losing it. And the secret, I've seen it in family offices, generational wealth. The big joke is the best way is to have a small fortune is to inherit a large fortune, because you don't know how to protect the wealth. You don't know how to protect it. You're always speculating, which is an important role in our mindset. But you have to preserve. You have to preserve and speculate. Gold is just simply hands down the best preservation asset. Bitcoin has a role too. It can do both. I think it's more of a speculation asset. I'm not here to mock it, but to preserve wealth generationally and to preserve your purchasing power, the case for gold to me is no longer even that debatable. And again, people say it's a bias. Yeah, it's a bias. I've chosen that bias, but it's a bias confirmed by thousands of years of history and cycle after cycle of empires and regimes and monarchies and democracies blowing up because they spend more than they earn. And the US is hitting that inflection point. None of us can time that, but it's already happened.
David Hunter's discourse pierces through the facade of market stability, revealing the undercurrents of a brewing financial tempest that could rival, if not dwarf, the crisis of the past. His prophecy doesn't just paint a picture of a downturn, it foretells a cataclysmic unraveling of financial markets, a descent that could see the equity market plunge by a staggering 80%, a scenario reminiscent of the dark days of 1929. Hunter's narrative isn't just an analysis, it's a forewarning of an economic and financial bust of global proportions, a crisis that threatens to eclipse the turmoil of 2008-9 in both scale and severity. Hunter elucidates the vulnerabilities that lie beneath the surface of the global banking system, a system intricately connected yet perilously leveraged. His focus isn't confined to a single region. It's a panoramic view of a global banking network teetering on the brink. From the overstretched banks of Europe, Asia, Canada, and Australia to the less leveraged but still vulnerable banks of the United States, Hunter maps out a financial landscape fraught with counterparty risk and systemic fragility. His outlook doesn't just forecast a downturn, it anticipates a series of domino effects, a cascade of crises that could see even the mightiest banks face the specter of bailouts or collapse. In Hunter's narrative, the looming crisis is not just an economic event. It's a symptom of a deeper malaise, the unprecedented levels of global debt, and the astronomical notional value of derivatives. This isn't just about numbers, it's about the very fabric of the global financial system, stretched to its limits and beyond. Hunter's portrayal of the global debt and derivatives market isn't just a snapshot, it's a stark reminder of the fragility of a financial system built on leverage, a system where each hiccup can amplify into a shockwave, where each tremor has the potential to trigger an avalanche. As we absorb the gravity of David Hunter's insights, we're not just spectators of an impending crisis, we're witnesses to a pivotal moment in financial history, a juncture that demands not just attention, but a profound reevaluation of our financial structures, strategies, and the very paradigms we've taken for granted. The narrative unfolding before us isn't just about the resurgence of gold or the decline of the dollar. It's about the seismic shifts in the financial bedrock, the tectonic movements that could reshape the landscape of global finance. But the narrative doesn't end here. Up next, we have the astute insights of Matthew Penberg, a seasoned observer of the financial landscape whose expertise extends beyond the conventional. Penberg's deep dive into the intricacies of monetary policies, his keen analysis of market trends, and his ability to decipher the signals in the economic noise promise to add another layer of depth to our understanding of this complex, evolving saga. Stay tuned as we delve into the profound perspectives of Matthew Penberg, unraveling the next chapter in this intricate tale of global finance and the forces that shape our collective future. In a world where economic narratives are meticulously crafted, Matthew Penberg's insights shine a light on the obscured realities of inflation and the true essence of wealth preservation. Penberg doesn't just dissect the figures reported by official statistics. He delves deeper, revealing a distortion in the very scales that measure our economic health. His analogy of a fat camp where the scales are tweaked to show a weight loss that isn't there isn't just an illustration. It's a stark representation of the manipulation in reporting inflation, a manipulation that has profound implications for everyone, from the middle class grappling with the invisible tax of rising costs to the investors seeking to preserve their wealth. The narrative Penberg presents is not just about the misrepresentation of inflation. It's about understanding the forces that drive these misrepresentations and recognizing the invisible shackles they impose on the economy. The rising rates, the stifled demand, the crippling burden on the middle class. These aren't just economic indicators. They are the harbingers of a disinflationary trend, a calm before the storm of higher inflation that looms on the horizon. As Penberg articulates, the impending wave of inflation isn't just a number. It's a force that erodes the inherent purchasing power of money, a force that transforms what appears to be a positive return on investments into a Sisyphean struggle against the devaluation of wealth. In this landscape of distorted scales and eroding value, Penberg's case for gold emerges not just as an investment strategy, but as a fundamental principle of wealth preservation. Gold in his narrative isn't a relic of the past, it's a beacon for the future, a steadfast guardian against the erosion of purchasing power. Penberg's discourse isn't just an analysis, it's a call to action. It's a reminder that in a world where currencies are under siege by their own creators, becoming one's own central banker by acquiring physical gold isn't just a strategy, it's a necessity. The journey of gold from being a mere asset to a symbol of preserved purchasing power is not just about market trends. It's about understanding the cyclical nature of history, of empires and regimes, of democracies and monarchies, all succumbing to the age-old adage of spending more than they earn. As we integrate Penberg's profound insights into our narrative, we're not just observing the market dynamics. We're weaving together a story of preservation, understanding the true value of wealth, not in numbers, but in stability and longevity. The story unfolding before us isn't just about the resurgence of gold or the decline of the dollar. It's about recognizing the signs, understanding the trends, and making informed choices that transcend the immediate, choices that secure not just wealth, but the very essence of what that wealth represents. The narrative, enriched by the insights of Matthew Penberg, is drawing towards a close. But before we reach the apex, the conclusion that ties together the threads of this complex tale, let's turn our attention to the final piece of the puzzle. Stay tuned as we bring this journey to its culmination, synthesizing the insights, the trends, and the strategies into a coherent whole, a narrative that doesn't just inform, but empowers and enlightens. Matthew Penberg's insights shed light on another concerning trend, the shift towards a digital monetary system. This isn't just about the convenience of digital transactions. It's about the potential for unprecedented levels of surveillance, control, and the erosion of financial privacy. In a system where every transaction is recorded, monitored, and potentially scrutinized, the autonomy of individuals and the sanctity of private wealth are at stake. In this digital dystopia, the role of physical gold transcends the realm of investment. It becomes a symbol of financial freedom, a means of preserving not just wealth, but the very essence of individual autonomy. In a world where digital currencies could be subject to negative interest rates, frozen, or confiscated, gold remains untouched, untouchable, and untraceable. As we navigate through the distorted narratives of inflation, as highlighted by Matthew Penberg, we're reminded of the insidious nature of this invisible tax. Inflation erodes the purchasing power of money, silently chipping away at the wealth of individuals, particularly those on fixed incomes or those whose savings and earnings fail to keep pace with the rising cost of living. In this context, gold's role is not just as a hedge against inflation, it's a protector against the silent theft of wealth. As central banks continue to monetize debt and as real rates of inflation outpace the officially reported figures, gold stands as a steadfast guardian, preserving the value of wealth in a way that fiat currencies, with their inherent susceptibility to devaluation, cannot. As we consider the global shift of economic power, the rise of BRICS nations, and the increasing skepticism towards traditional financial systems, we're witnessing a transformation in the very architecture of global finance. The move away from the dollar, the exploration of alternative reserve currencies, and the potential establishment of a BRICS trade settlement currency based on gold all point towards a future where the dominance of traditional powers is challenged and new alliances are formed. In this emerging landscape, gold's role is not just as a safe haven or a store of value. It's a potential cornerstone for new financial systems, a universally recognized asset that could underpin new frameworks of trade and economic cooperation, untethered from the geopolitical and economic policies of any single nation. As we reach the apex of our narrative, we're reminded of the enduring wisdom encapsulated in the role of gold. In a world of extreme uncertainty, where geopolitical tensions simmer and economic foundations wobble, gold remains a constant, a beacon of stability, a vessel of value, and a shield against the systemic risks that pervade our modern financial systems. The journey we've embarked upon isn't just about understanding the dynamics of markets or the trends in investment. It's about recognizing the timeless principles that govern wealth, stability, and preservation. It's about acknowledging that in times of tumult, the truest form of wealth isn't the numbers on a screen or the digits in a bank account. It's the tangible, immutable value of gold, an asset that has weathered the storms of history and emerged time and again as the ultimate harbor in times of turmoil. As we conclude this journey, remember that the insights we share are not just points of information. They are beacons that guide us through the complex landscape of global finance, illuminating a path towards stability, preservation, and enduring value.